Good afternoon, everybody. I'm Paula Clarkson from Merhab Robinson and Clarkson, and I have Jim Kieckhafer here from Kieckhafer Schiffer, and we're going to talk to you today about the tax moves that you can make before the year end. Most of these strategies are related to the current passage of the Big Beautiful Bill. So just to give you some background about Jim and myself, as you're aware, MRC does estate planning and business planning. We do all aspects of planning and trust administration, as well as probate and business planning from startup to employment, um, work for business owners, as well as helping you sell when you're ready to retire. And Jim's firm does estate planning, or sorry, tax planning and audit planning for individuals and business owners of all sizes and stages of their careers. So let's go ahead and jump in. We're going to talk a little bit about what the Big Beautiful Bill did, the changes that it has an effect on estate planning, as well as the tax brackets, state and local taxation changes that have happened, as well as some business benefits such as bonus depreciation. There's electric vehicle and energy credits, as well as some overtime tax credits, loan interest that you can take advantage of within a short period of time. So the OBBB, often called the Big Beautiful Bill, was passed on July 4th, 2025. Some of the items take effect immediately, and some of the provisions take effect in the future. And although some items, as we're going to discuss today on some of the credits, are going to expire, basically made permanent a lot of the laws that were put into effect from the Tax Cuts and Jobs Acts that was enacted in 2017 that were set to expire at the end of this year. So although we are going to go over a few of the topics today, obviously it's almost a million or a thousand page legislation. We're not going to be able to cover every topic, but we thought we would touch on some of the most important ones for people, individuals, as well as businesses today. So let's go ahead and get started with the changes that are taking effect for the estate, gift, and generation skipping transfer taxes. So the good news that we have is that starting in 2026, any individual can pass away and pass $15 million estate tax and generation skipping tax free. And if you're married, that's 15 million per person, so 30 million as a couple. Currently, the amount is 13,999,000, and that was set to expire at the end of this year. So it's nice to have some permanence. There is no expiration on this at this point. With everything with Congress, it's permanent until they change the law in the future. So looking at it will give you at least some certainty for the years to come. And this $15 million amount will also be subject to inflation adjustment. So that's where we get the odd numbers like the 13,999,000. So periodically it'll increase every year, and that can only help with how much you'll be able to transfer. And going back, we call it the estate tax exemption, but it's also a gifting exemption because it allows you to gift that amount during your life or pass it at your death. So it can be used for either of them. So it's a good idea then to look, and we can review your estate plan to determine if there is any estate tax due, and perhaps look into making your estate plan either less complicated because we were doing a lot more planning before with the lower exemptions, or we can look into figuring out how to reduce your estate further. So, as I mentioned, over the last, I mean, really since 2005, since the second President Bush was in office, the estate tax limits have been changing. So there's been a lot of uncertainty, and they've only been increasing, which has been very helpful. So a lot of the planning that we were doing in the past, such as dividing the trust when the first spouse dies, creating bypass trust in order to take advantage of some of the planning, isn't necessary for a lot of people anymore. It's still important for higher estates that may exceed the 15 million, or if we're going to do some type of planning that could involve asset protection, as opposed to just gift planning, like in second marriages, allowing the spouse to be able to use that, bypass trust, but not giving them the option to be able to dispose of those assets. So although the estate and gift tax exemption being higher does help simplify plans, depending on your situation, we may want to still use some of those techniques. So let's talk about some of the ways that we can take advantage of the 15 million, why it's here. We can start using it to make gifts. A lot of times people will make gifts during their lifetime in order to reduce their estate. So for example, if I gave away assets now, the appreciation on those assets is not in my estate. It will be in the estate of the person I give it to. So there's a lot of ways that you can make gifts and take advantage of that 15 million by still and then still retain other assets in your estate, but at least remove that appreciation, especially if you have a highly appreciating asset. Being able to move some or all of that appreciation over to maybe a child or a spouse, then can save your family a lot of money. We can also use the 15 million to exemption to take advantage of some discounts. When you give an asset that is less than 50%, whether it's a piece of real estate, a business interest, then when we're valuing that asset for gift tax purposes, if there's a lack of marketability, a minority interest, we may be able to value it less than it actually is worth to take advantage of using more of your gift tax and estate tax exemption to transfer that asset. Um, we also still want to consider gifting to reduced income taxes, for example, on sales of businesses that might be subject to a large amount of income tax due when they're sold, looking into potentially charitable plans, charitable remainder trust to look at the overall um, strategic planning for you individually, and not necessarily your heirs, but looking during your lifetime and making those gifts with your 15 million could be considerable. I know the gifting is quite confusing, so I wanted to go through an example for you. So there are two different parts to gifting. The first part is we have an annual gift that we're allowed to give every year. So these are considered lifetime gifts. So 19,000 is the limit right now. So I could give everybody in the world that I come across $19,000 a year, and it's gift tax free. And as a reminder that the person who receives the gift, it's always gift tax free to them. The person who is taxed is the giver, the donor. So I could give everybody that I run into $19,000 every calendar year, and there would be absolutely no gift tax required. I would not have to report it. So that's nice and easy. It's unlimited if I make the gift for education or medical expenses. So if I want to pay for my friend's daughter to go to university, I give her money in order to pay for the university. But in order to avoid that $19,000 limit, because we all know tuition is generally higher these days, I can pay the university directly because it's an educational expense. Then I could give her $30,000 in 1 year and there'd be no gift tax consequences to me. However, if I gave the daughter the 30,000 and said, please pay your tuition with it, then I'm limited to the 19,000, and the additional 11,000 I have to report as a gift. Also, the same thing with your medical expenses. So if you could give each of your children 19,000, and then if you pay their medical bills directly to the dentist, to their medical providers, that can be an addition and you would not have to report that. And when we're looking at the 19,000, we're looking at that on a calendar year basis. Then we have the transfers at death that I mentioned, the $15 million. So if I go above my 19,000 in a year, it's supposed to reduce my 15 million. So here's an example on the right-hand side. If I have a $15 million lifetime exemption, which I will have in January, and I give $1 million to each of my children, we take the $1 million, the first 19,000 for each of them is gift tax free. So that means that I have given them a partially taxable gift. But again, it's only taxable to me. But since I'm allowed to give 15 million either during my life or at death, all it does is reduce the amount that I'm able to give at death. So now, after making those $1 million gifts, I can only give away 13,038,000 at gift or at death before I start incurring estate taxes. So if I were to pass away and my estate was at $14 million and I had a remaining exemption of 13,038,000, the difference would be subject to 40% estate tax upon my passing. But generally, the idea is to make a gift during life so that the appreciation is over on the children's side or the other beneficiary, and I'm able to then reduce my estate and even further preventing additional tax on that 40%. Some gifting opportunities that we now have, a new one is with Trump accounts. These are new accounts that the federal government is going to be making a one-time contribution of $1,000 into an investment account for every American baby born in 2025 through 2028. So this is a short period of time. So $1,000 will get put in, and it's basically treated like an IRA. So the family members and can make contributions to this of $5,000 per year. That's the max contribution. So if a child was born in 2025, 1,000 is put in, and then let's say their grandparents put in $5,000 every year until they're 18, or during this period, those funds can grow tax deferred. And then when the child turns 18, they can start making distributions. It's basically treated as an IRA when they're 18. And if they make withdrawals before they're 59 and a half, then there is going to be income tax on the growth in those assets with a penalty, unless the child uses it for college tuition or for a first time home with a limit of $10,000. So this could be a great way to start getting that IRA set up for them. Even if you're only able to put in for a few years, the compounding on that by the time this newborn child in 2025 turn 59 and a half could be substantial with only putting in a few years worth of assets contributions. So this is a great way to use your $19,000 that you can transfer gift tax free. You can also use it your 19,000 to put into 529 plans. Some people will put it into an HSA plan, a Roth plan. So I think overall, you just look at it, what is the best vehicle? Everyone has slightly different benefits, such as the 529 plan, distributions being used for education, and they can grow and the funds can be taken out tax-free. But then when the funds are left over, it then essentially converts over to an IRA, but there are some limitations on the amount that can be turned over. So depending on the situation, it's a good idea to take a look at things, but we at least have one more vehicle that you can contribute, and your grandchildren or children can start, getting those IRAs growing over their lifetime and take advantage of that compounding while they're alive. So I'm going to turn it over to Jim now. He's going to go through all the different tax issues and changes that are affecting all of us.
Sure, thank you, Paula. So the first one here is the tax brackets that were introduced in the 2017 tax bill. These tax rates were set to expire at the end of this year, and they've now become permanent. And as Paula said, they're permanent until Congress passes a tax bill to change them, but at least they're codified as not having to sunset anymore like they were. So the rates, I think, are on the next slide. Yeah, right here. So the rates have been in existence since 2017, but they've been indexed for inflation. So the actual bracket points have changed, but the rates have been the same. This senior bonus deduction is what came out of the originally when Trump was campaigning. He was no tax on Social Security, and in the joint committees and discussion on the bill, this became a senior bonus deduction, and it's an above the line deduction. So if somebody over, it's for 65 and older. If you do not itemize deductions, you're still able to get this $6,000 offset to your adjusted gross income, reducing your income, 12,000 for married, and it phases out on income over 75,000 or 150,000 for married filing joint. The SALT deduction, state and local tax, this was in 2017 was reduced to $10,000. That's now increased to 40,000 just for 2025 through 2029. And it goes up. It's also indexed for inflation. So in 2026, it's going to be 40,400. And there's a 1% increase each of the next years. This also has a phase out. So at 500,000 of income, the amount is reduced by 30% of the income above that threshold. But it never, the 40,000 itemized deduction never drops below the original 10,000, which has been in place since 2017. So I think on this one, I'm sure most of the participants are California, and if you own a home, you've got California real estate taxes and high state and local taxes. But if you don't hit that number, trying to bunch it up in the year, if you have ability to pay it, the timing when your income is not going to cause a phase out. The bonus depreciation updates, the original Tax Act in 2017 allowed for an expensing of qualified property, and that had been phasing out. We were down to 40% was eligible to be deducted. Now that number is back to the 100%. And you can elect out of it, but if you have an acquisition of property after January 20th of 2025, you're able to fully expense that if you meet the capital improvement limitations. The business investments, couple of different things here. I think it's just looking at where the discussion here was on looking at where to invest it. If you've got capital improvements, if you want to make those from the tax impact with the bonus depreciation, and how you use the bonus and the 179 to optimize your taxable income. Paula, do you want to jump on these credits? I'm not sure if you want to take them, they're phasing out, or
Yes, that's great. There's some energy and electric vehicle tax credits that are phasing out pretty quickly. The EV credits are set to expire after September 30th, 2025. So just over a month away. So it's very important for anybody looking to get an electric vehicle, whether it's personally or for your business, to make sure that you go ahead and take advantage of that sooner rather than later, or else you're going to lose it. Like I said, we're looking at September 30th as a very, very quick deadline for your business. And then there's a lot of other business, there's a lot of credits, whether it's for solar, for clean energy. A lot of them relate to business owners, and but the bottom line is a lot of those are phasing out quickly. So if there is any energy credits that your business may be looking for, you really should take advantage of these very quickly. Most of them are expiring over the next few months, several even before the end of the year. So just depending on what your specific situation is, please be aware of the deadline if you're going to take advantage of that. So, just like Jim was talking about with the deductions, although there are some credits that have to be done, we want to take advantage of the depreciation for businesses as well. Just timing of these is very important for your business strategy, and talking to your tax advisor to make sure that you can take advantage of everything that you can.
And there were a couple, Paul, on there of residential energy credits and things that needed to be completed by the end of the year as well.
Mhm.
Not just business ones, but residential.
Yeah. So Jim, do you want to talk about
Sure.
the taxes on the tips, and which has been a big big
Yeah.
issue?
This was obviously a big campaign issue on no tax on tips, trying to get the middle class or lower middle class to be able to take home more pay. And the uh, tips are still being subject to tax by the employers, but the individual will get a up to $25,000 deduction for qualified tips and get those taxes back. So this is also effective for 2025, and we've had a lot of clients asking us, well, how do we stop withholding on the tips and everything? But the answer there, the employer will still withhold, and then the individual, when they file their tax return, will get this $25,000 credit, and it phases out on income over 150,000 or 300,000 for joint qualifiers, or I'm sorry, joint filers. And then that money will obviously come back to those individuals when they file their tax return.
Yeah, and it's on qualified tips. There's a list of what are regularly areas that you receive tips. So you can't change your sales or anything into that and call them tips in order to take advantage of this credit.
Good point. Thank you.
Mhm.
There also, similar to the tips, there's a deduction of 12,500 for overtime pay. It's intended to be half of the time and a half compensation, and has similar phase outs, the 150 to 300,000 for married filing joint. And the intent is the same. It's trying to get more take home pay into the hands of the lower middle class to allow more money to flow into the economy. Auto loan interest deduction. This is the intended to, well, I guess first off, it's not an itemized deduction. It's also above the line, up to $10,000, and it's intended to get autos that are manufactured final assembly in the United States, that those purchases would be eligible for an interest deduction above the line. So again, trying to spur investment into U.S. built autos.
This one's also limited just till 2028. So it's very important to make sure that, although you may want to buy the EV during this time, but the loan interest doesn't take effect. You can only deduct loan interest after December 31st, 2024. So look at all the timing so that you can stack these if possible.
Correct.
Yeah. And there's obviously requirements.
Obviously, some limitations. That's right. I mentioned already the final assembly must occur in the United States. It's got to be less than 14,000 pounds. That's a pretty large vehicle. Um, and you've got they're going to track it by the VIN numbers to confirm that it was actually built here. Their final assembly was done in the U.S.
So this was just a small amount of the tax law changes that have been happening. The biggest part is that there's a lot going on, so it's really important to take a look at your estate plans, keep involved with your tax advisor, to go through these issues to see what is important, what can be implemented, when it has to be implemented, based on your planning. Um, So I know we talked, just about a bunch of different things, but I wanted to kind of open it up and see if there was any questions, just, more generically, and how this would affect. Um, Looks like we do have a question about the personal tax credits for the home solar. And that was one of the items that Jim was talking about.
Yeah, they're expiring as well. And Paula, do you have that chart that had the expiration dates? I don't know if you can jump to the one you
Yes.
backed up to it earlier, but it
Yes.
had the date in there.
Yes. Let's see.
And while she's pulling that up, there has been a bunch of guidance just starting to come out the last week or so on what constitutes the start of construction, because the construction of the home solar has to begin, I think, before the end of 2025. So you have to be under construction, and I think that entails about 30% of the cost must be paid, and they must have started with the installation.
Yes. Yes. And it's looking at December 31st, 2025.
Yeah, that's what I thought. Yeah.
Yes. Yes. So that's coming up very quickly as well to be able to make those, take advantage of those credits. So there's a lot with, the reporting for business owners, with regard to the taxes, for the tips and the overtime. So there's going to be a little bit more of a burden, on everybody reporting to make sure that that is done correctly, and in a timely manner. So,
Yeah, if you have a business that you're paying overtime or paying tips on it, make sure that your payroll provider, if you're using an outsourced one, most of the big ones, I'm sure, will have it in line by the end of the year, but that's going to be critical that that stuff's reported correctly.
and then, okay. Yeah, there's a question about whether they'll get a copy of the slides. Yes, after the presentation, we'll send out a replay as well as the slides, to you as well. And then there's also a question that what happens if you gift more than 19,000 per year? So if I gift one person 25,000, then I'm supposed to file a gift tax return for the addition and report the full $25,000 of the gift. The first 19,000 is going to be gift tax free, and the other 6,000 reduces the 15 million that I can pass when I die. So it's basically the gift tax returns are keeping track of the gifts that you make during your lifetime. Because it reduces the 15 million that I have, I won't have to pay any gift tax, on it until I use up that full 15 million. And the gift tax returns are due April 15th of the year following the time the gift is made. And depending on the type of gift you give, you may need to value it. For example, if you gave real estate or stocks or business interest, you're going to need a valuation to determine the gift. But if you gave cash, that's much easier.
And Paul, I think your point, the gift tax return is really a running balance of the unused 15 million. And as you make gifts over the years, that balance, that running total is decreasing if you're exceeding the 19,000. So it's just a kind of a running balance of how much you have remaining.
Right, right. And there's another question about that the 529 money, a client's son had rolled after they finished college, rolled that money over into a Roth, and asking if there's any sunset on that. I don't believe there is. That's been in place prior to the OBBB, so it's a great way to take advantage of it. I thought there was a limit on it of you could only roll over maybe 30,000 or something. Jim, do you know about that?
Um, there is a limit that was part of the Secure Act, and they allowed you to roll over a certain amount of that excess, and I believe it is around about 30,000 that could be rolled over, and the rest has to be pulled out with penalties if it can't be rolled to another beneficiary.
Yeah. Yeah. So that's a great option to do for the 529 plans. And that's where you can compare whether doing that, putting more money into the 529 plan versus the Trump deposits based on, the requirement. Because if you end up with too much money in the 529 plan, you're not necessarily able to roll over more than a certain amount versus with the Trump plans, you're able to basically turn it into an IRA and have it tax deferred for basically, until they turn 59 and a half. So looking at, where you're putting the money and how it's going to grow and for their lifetime is really important on making those gifts. And then there's another question about this person has solar. Do I have to get a battery prior to December 25th to get the tax credit on the battery?
Yes, that is correct.
Yeah, but if it look at it was before, yeah, before the end of the year, before December 2025. So yeah, taking advantage of those and timing purchases correctly. So great. It looks like that is the end of the questions. When we send out the information, feel free to reach out if you have any additional questions. Jim's, we can give you Jim's information as well. As we mentioned, there's a lot of personal, there's a lot of business issues, and often they're intertwined when preparing your own taxes to save money for your families overall. So feel free to reach out anytime and we'll be happy to get back to you. Our next webinar is on September 17th at 12 p.m. And we're going to be talking about charitable planning and how you can make some gifts prior to the end of the year that may be able to help your personal income taxes as well as fulfill the legacy that you want to leave behind. Great. Thank you all for joining us, and we hope you have a wonderful day.
Thank you, everybody.